Your bank keeps telling you this account is free, no monthly fee, no minimum balance. Sounds perfect, right? But here's what nobody's telling you. Free checking isn't free. It just moves the cost somewhere you're not looking. Millions of people picked their checking account because of one word on a sign. Free. No catch, they figured. No fine print. Just a place to keep your paycheck safe. But banks don't build billion-dollar buildings by giving things away. Someone always pays. So if it's not you through a monthly fee, who is it? Let's start with the obvious question. How does a bank make money on an account that costs you nothing? Think about it for a second. A bank isn't a charity, it's a business, and every business needs revenue from somewhere. Here's the first piece nobody explains clearly. When you deposit your paycheck, the bank doesn't just hold your money in a vault, it lends most of it out. Mortgages, car loans, credit cards. Your checking balance becomes the raw material for someone else's loan. The bank pays you close to nothing in interest, then turns around and lends that same money out at 4, 5, sometimes over 20%. That spread is the first hidden engine behind your free account. But that's not the part that really stings. That's not the catch. The catch shows up when you slip up. Overdraft fees. This is where the real money gets made. According to the Consumer Financial Protection Bureau, banks and credit unions collected close to $8 billion in overdraft and non-sufficient fund fees in a single recent year. $8 billion from accounts that were marketed as free. And the average overdraft fee itself, around $30 based on national banking surveys. $30 for being a few dollars short on a $5 coffee. Let that sink in. You overdraw by $5 and the bank charges you $30. That's not a fee. That's a 600% penalty on the shortfall. Here's the part that makes it worse. Some banks used to reorder your transactions. Instead of processing them in the order you actually made them, they'd process the largest one first. That way, if you had 4 small purchases and 1 big one, your account would hit 0 faster, and you'd rack up multiple overdraft fees instead of just one. Regulators cracked down on the worst of this, but the incentive never fully disappeared. The system is still built to notice when you're low, not to protect you from going lower. So why doesn't this feel like the trap it is? Because it's disguised as convenience. The bank doesn't decline your card when you're short. It approves the purchase quietly and charges you for the privilege of not knowing you were about to go negative. It feels like the bank is doing you a favor. It's not. It's billing you for a service you never asked for. Now let's talk about the second quiet cost. Minimum balance requirements dressed up as free if. Many accounts marketed as no fee actually require you to keep a minimum balance or receive a certain amount in direct deposits or use your debit card a set number of times a month. Miss the requirement, even by $1 or one swipe, and the fee kicks in retroactively. You didn't get a free account. You got a conditional one, and the condition was never front and center. Then there's the interest you're not earning. This one's invisible, so it never feels like a cost, but it is. The average checking account pays close to nothing in interest, often a small fraction of 1%. Meanwhile, inflation and even basic high-yield savings accounts have offered returns many times higher. Every dollar sitting in a low-interest checking account is a dollar quietly losing purchasing power while the bank lends out that same dollar for real profit. You're not being charged a fee. You're just not being paid what your money is worth. So is a no-fee checking account actually bad? Not necessarily. For a lot of people, it's still the right tool. If you keep a cushion in your account, avoid overdrafts, and don't chase interest on your everyday spending cash, a free checking account does exactly what it promises. No monthly fee, no hassle. The danger isn't the account itself. The danger is not knowing where the real cost is hiding. Here's the honest takeaway. A free checking account is free the way a free trial is free. Someone somewhere is still getting paid. In this case, it's usually the person who overdraws occasionally, keeps a low balance, or never checks how much interest they're missing out on. If that's not you, the account really can cost you nothing. If it might be you, here's what to actually do about it. First, turn off overdraft coverage on debit card purchases, or opt for a linked savings account as backup instead of paying a standalone fee. Second, check whether your bank has hidden minimum balance or direct deposit requirements buried in the terms. Third, if you're consistently keeping more than $1,000 in checking, consider moving the excess into a high-yield savings account instead, where it can actually earn something close to current market rates instead of sitting idle. None of this means switch banks in a panic. It means read the terms once, actually understand where the fees live, and make sure you're not the one quietly subsidizing everyone else's free account. Your bank keeps telling you this account is free, and technically it is, just maybe not for you.